Well, for what today's news all means for debt capital markets, we're joined now by Stephen Nash from FIG Securities in Sydney. And Stephen, of course, we've had so much news come out by way of manufacturing data and these bank downgrades from Moody's. I just want to start with that Moody's downgrade. Of course, 15 of the world's largest banks. It was pretty much expected, not too much in terms of a surprise there, and certainly some banks copying it less harsh than others.
Yeah.
I guess the overall question that it raises for me is now what type of collateral these institutions are likely to put up to try to get that risk at least perceived to be a little bit less than it may possibly be.
Yeah, the announcements are quite significant in the sense that banks like Morgan Stanley have moved now down into the BBB range. Now, typically for a bank it's very difficult for those institutions to operate in that sort of rating band, and there may be some mandates that will have to adjust their portfolios and sell those bonds given that rating towards the end of the month. However, the market, as you say, has anticipated this well. I think Moody's have done a very good job in terms of possibly overestimating the downgrades for a lot of these institutions, and given that it's not a triple notch downgrade, it appears to be a good result. However, the institutions, I think, going forward will find it a little bit challenging. I mean, this is really a lot of this is all a result of the Dodd-Frank legislation, where the systemic support has been effectively taken away from the rating. So it's been a long time coming, but now we're here. The market seems to be reasonably happy with it, but it may have been a factor that affected equity markets last night in New York.
Yeah, indeed. Also, I'm sure coupled with that manufacturing data from China, Europe and the US, all very much disappointing, and that's certainly adding a negative to spin, indeed, to trading across equity markets. And it just seems like, indeed, it has been a bit of a reality check following that, of course, Greek election, post-Greek election rally that we saw, which was quite short-lived in the scheme of things, and certainly those hopes of the FOMC easing or stimulus of some form were very short-lived as well, and it seems markets, equity markets at least, are pretty much back into the reality of where things are post that manufacturing data last night.
Yeah, well, I think the market really anticipated the Fed move. Yes, it could have been better, could have been bigger, could have been a full-blown QE3. However, it was good to see that there was some action. I think as I said before, I think this is the Fed building a bridge towards initiating QE3. They do have participants within the FOMC that are opposed to this. They've got to bring those people across. And I also think that they're very concerned about the European situation. They do have limited resources. They can't do QE25. They will do this QE when it's appropriate, and they're quite concerned about the situation in Europe. There is a real risk scenario here, particularly with regard to the funding of the sovereign markets like Spain at this stage.
And indeed, when you look through that Fed statement, the comments coming from that, or the sentiment at least, quite dovish.
Yeah, look, I think the dovish tone really was started by the Yellen speech, which was a few weeks earlier. I think going forward, market participants should really focus on Yellen as a spokesperson for the Fed, and it's been dovish. There hasn't been really any change there. I think over time we may see the tightening date pushed out to 2015 as well.
Yeah, indeed. That's quite interesting that you say that, given, I guess, what's happening on the US economy, the downward revision that the Fed indeed made to the growth forecast there, plus the upward revision to unemployment, which is still a big issue to overcome. In light of that, do you think that the US is still on track in relation to its recovery?
Look, I think that what's happened is we've had a lot of pull forward of consumption with the warmer than expected winter we had, and I think also expectations ran a little bit too strongly in the first quarter. I think we have the seeds of recovery in place now. We've got this oil price below $80, which was unimaginable earlier on in the year. Now we have very low rates. We have the 30-10 spread contracting as well. And I think those sort of things are going to be very positive for the US at some point. But I think the problem right now for markets is the European situation, and I expect that that problem will intensify in the next week to a month, and we should get some resolution of that fairly soon.
Spanish bond yields at least improving for the short term, so that's probably a good sign, and hopefully a little bit more of a concrete resolution by way of a policy perhaps coming out of this EU summit coming up. That's though still, I guess, setting the precedent for what has been an increased appetite for debt rather than equities. Do you see this trend continuing?
Look, I think, yeah, there is a genuine increase in preference for debt as opposed to equity. We saw that the RBA had published a report in the bulletin, RBA bulletin, about risk preferences reducing. That's consistent with consumers being very conservative right now, and preference for risk has dropped. And now it's official, I suppose you could say, that it's been acknowledged that consumers and investors have a consistent view of the world, and that's much more towards less risk right now. So bonds fit in there between cash and equities quite well, and I think that demand is evident in the recent increase in listed debt issues.
Yeah, that's right. We've certainly seen that increase. What about funding markets in general? Are the banks still, I guess, having access to the capital at the moment, or is that starting to narrow somewhat?
Well, I think in Europe it's quite tricky to say the least right now. Most of the major banks have completed a lot of their funding. There is some residual to do. We've seen some tapping of existing lines by some of the major banks this week. Probably expect a little bit more of that to proceed going forward, rather than doing or leading new issues, just expansion of existing lines. So I suppose that indicates the domestic market is well and truly open for the major banks. There hasn't been any major widening of spreads here at all in the last few weeks. So in terms of major bank domestic funding, the market's open, but in terms of global funding, it's a little bit tricky right now.
All right, Stephen Nash, FIG Securities, we'll have to leave it there. Have a great weekend, and thanks so much for joining us.
Thanks very much.